Yo, what is up, guys? It is Kiss, and we're back. It's been a while, guys, but today I'm going to be doing a daily recap. Today is May 28th, and to be honest, this is one of the cleanest price action days I've seen in a while in the year of 2024. So we're going to start off from left to right, starting with Asia session, London session, and then New York Open, and how we can really capitalize off of liquidity levels and fair value. How we can find reversals and how we can find entries off of these reversals. So starting off with the left, we're gonna, first of all, before market open, what I do is I like to mark out three things mainly. I like to mark out midnight open, I like to mark out Asia and London high and low. So for example, in today's session, so this is Tuesday, we have yesterday, Monday, it was a bank holiday. So today we mark out Asia session low, should be right here. Asia session books higher, midnight open. From midnight open, we have a London low formed, used as manipulation during London. And then we have an expansion higher, forming the high of week or the high of day in this scenario. Now, with this in mind, going into New York Open, which would be right here, obviously in hindsight, we see that we tapped into a 15-minute imbalance. But let's see what happens when we pull over Asia and London lows. Now that we've formed a London high, we would assume New York would be the continuation off of the London reversal. Now, I'm going to mark out this 15-minute SIBI here, which if I go on the 15-minute time frame, it was left unmitigated, untapped, leaving, as some may call it, smooth edges right here, right? We have relative equal highs formed here. New York open at 9:30, we wick higher, which would be the manipulation into the 15-minute imbalance. Off of the 15-minute imbalance, you can find a model. So we can use the 15-minute imbalance as a higher time frame PD array. So off the higher time frame PD array, which would in this case be the 15-minute imbalance, we can use this as a market maker model high, right? So what our model would provide would be a liquidity sweep and then inducement into a higher time frame PD array. So inducement occurs here when price sweeps previous liquidity prior to New York Open. We have a consolidation. We have a retracement into our 15-minute imbalance, which would be here, right? Now, how can we capitalize off of this move right here? Now, obviously, we have a move higher, inducing stops and manipulating orders into the market, buyers wanting to go long, and then we manipulate them going lower, right? Now, if we look to the left on the liquidity sweep leg, I'm on the 2-minute time frame right now, but if you look to the left, we have a 2-minute imbalance, a 2-minute BISI. Now, this 2-minute BISI is obviously going to book higher, right, into the 15-minute imbalance. But what occurs when we close back below it, right? This is a market structure shift, and we also have another imbalance down here. We don't have a change in the state of delivery yet, considering that these order blocks are still not yet disrespected. Notice how if we look at the 932 candle right here, we didn't close below it. So we still do not have a change in the state of delivery. So as of now, to really capitalize off of this move, we need to be looking at the imbalances. Now, our 932 candle, we displace lower, confirming bearish order flow. And then the next candle following, the 934 candle, we retrace, tapping into our previously marked inverse fair value gap, right? So our bullish fair value gap now becomes an inverse. We tap back into it. That would be your hypothetical entry here. Stop loss would be, personally, my stop is usually 25 points, so this is actually perfect, 21-point stop. You would do a 1-to-1, which would in this case be right there, 1-to-1. But remember how we marked out the session lows? So previously we marked out London low, which was swept by 8:30 open, as we can note here. 8:30 open, which is this candle right here. If you guys trade prior to 9:30, typically 8:30 will seek a liquidity level, either session high or low, or a significant high or low, which in this case was a London low, which is a session low. We swept lower, manipulated higher, and then ultimately targeted Asia low, which in this case, if you were in this trade, this would be your target for a 1.5 R. So 21 point stop, 31 point TP. Or there's another way of targeting. So you can either target session highs or lows, or you can also use standard deviations to project your displacement leg lower. In this case, I would personally use the last leg that swept liquidity. So if I get rid of this, I would use the wick high. So this is the last leg that swept liquidity right here, right? We have this wick low, wick high. You can even use the entire move higher. But if you're on a slower time frame, just use the last leg that swept liquidity, which would be these two candles here, which were the candles that induced stops right there. So take that leg, wick to body if you want. You can do wick to body or wick to wick, depending on how far you want to project. If you do wick to body, you're going to have closer projections. And as we can see here, the 2 to the 2.5 lines up with our Asia low, right? So this would be a nice lineup right here. Good target. If you do wick to wick right here, you would obviously catch a little bit more of the move. 2 to the 2.5 is down here. So this is when you would expect a reversal, which is actually where we consolidate and we reverse for the AM session. I'm going to open up chat here. Before I move forward, does everyone understand the standard deviations projections? 1 to the 1.5, 2 to the 2.5. If you don't, let me know so I can explain them really quickly. They're not really levels, they're more used as zones. I can definitely go over it. Explain? Alright, respond. So, assuming we use wick to wick, we can also use wick to body, but assuming we use wick to wick on the last leg that swept liquidity, you're obviously going to be hitting the 1 to the 1.5 standard deviation first, so that's going to be your silver bullet zone. However, this isn't in silver bullet area. This is obviously at 938. The standard deviation projection works best during a silver bullet macro, which would be 10 to 11 a.m., 2 to 3 p.m., or 3 to 4 a.m., which is London. Well, in this case, 1 to the 1.5 is where you would expect price to reaccumulate and redistribute. So what does that mean if we're talking in terms of market maker models? Reaccumulation is typically when price expands or is consolidating. So if price is consolidating, and let's say we expand lower, right? The reaccumulation would be price seeking fair value in the distribution leg, and then it redistributes, seeking a liquidity pool or a significant target, which in this case would be the 2 to the 2.5, right? So reaccumulation is simply, in simple terms, it is just retracement, reversal, right? So we obviously retrace here at the 1 to the 1.5 when we tap into it there. We redistribute where exactly, right? The inverse. We have this one below. So if you missed entry at the first position, price offers a secondary entry when we reaccumulate. So if you ever do miss an entry on the first move lower, price will always offer it one more time in case you missed it. So in this case, price offered fair value. Remember what we talked about? Price will either go to premium discount, it will offer fair value to those who didn't make the first leg of distribution. So we can see here premium discount on the distribution leg from this high to this low where we tapped into the 1 to the 1.5. Price retraces where? Right into premium, right? Right above the equilibrium of the move lower. As soon as it taps into premium, We seek fair value, which is the inverse. We redistribute down to the 2 to the 2.5. Now, how can we capitalize off of a reversal once you see the AM move, right? So typically at 9:30, you're going to see a significant move lower or higher. And I personally don't trade this move. I'm just currently journaling this to, have it in the books, have it in my notes to know for next time there is a potential offer to enter the market a little bit prior to 10 a.m., which is when I prefer to trade, which is obviously your silver bullet zone, right? It's best your best area to trade in. So 10 a.m. opens here, right? We have this 10 a.m. candle here, and obviously I have SMT marked out here already. Now, that's because we have SMT with ES. So if I bring up ES here at 10 a.m., here it is. All right, so we have these lows right here, right? So this is currently the 2-minute. Let's pull up the 2-minute here on ES. Right here. Okay, so we have our AM session move lower, right? So we have our significant displacement lower here, right? Same with ES, significant. So far we're correlated, right? Now, how can we capitalize off of a reversal knowing that price may reverse at the 2 to the 2.5, which is this area right here? So we already have the move lower. Obviously, once price taps into the 2 to the 2.5, I personally don't like to participate in the move anymore because I would expect a deep retracement or a reversal off of the 2 to the 2.5. Now, once price enters or taps into the 2 to the 2.5, I like to pull open ES and I like to seek SMT, which in this case, what can we notice about these two lows here? So we have one low at 9:46 and we have another low at 10:02. Now, if I hover my candle or my cursor on the left side of the chart here, it will actually hover on the right side of the chart, as you can see, right? So if I hover my cursor on NQ here at 9:46 and you look on the right side, which is ES, at the same exact time at 9:46 on the crosshair, we have a low made, right? But what do we notice about the other low at 10:02 on NQ and the same low on ES at 10:02? It's pretty obvious, right? So we have SMT, which means that NQ made a higher high and ES made a lower low, right? So ES decided to sweep one more time, NQ didn't. So NQ reaccumulated positions. ES actually it did a stop rate. It seeked those stops, those positions, while NQ didn't. Now this is the market tipping its hand to you, letting you know it's going to be reversing, right? Smart money reversal, smart money timing right here at 10:02. Why is 10 so important? It's the beginning of a new 4-hour candle, right? So that's why I prefer to trade at 10:02 because the power of 3 is much more significant at 10 than at 9:30 because at 9:30 the 4-hour candle has already developed from 6 a.m. So if we take 6 a.m. open, which would be right here, it would be all the way up here, right? So you wouldn't be able to capitalize off of this power of 3, off of this 4-hour, right? Market opens and just dumps, right? So you can't really capitalize off of a 4-hour power of 3 prior to 10 a.m., right? Which is why I prefer not to trade 9:30. At 10 a.m., you're going to see price manipulate. And that's why the 10 a.m. candle typically makes a AM session high or low because price will manipulate higher or lower and seek either a London high, London low, Asia high, Asia low, or a significant reversal area. With this in mind, 10 a.m. opens and does what? Immediately displaces lower, right? So 10 a.m. was this black candle right here. Immediate displaces lower. All right, at the same time, you should be watching ES, all right? So if I take that same exact 10 a.m. candle on ES, it's going to be right here. All right. We immediately displace lower on ES. All right, with this in mind, how can you capitalize off of a move like this? Now there was a very obvious one that actually signaled in the chat. If you guys go back to right around 10:05 today, I'll actually screenshot it and send it in the chat. I said at 10:14 Eastern time, I said there is a 5-minute inverse, right? And we closed above it. So let me actually send that in the chat. There we go. I'll answer your question in just a second, Invest. Give me 1 second. So let's get rid of everything to the left here. The 9:30 move lower. Let's get rid of all that. All right. So now we're going to be focusing on the 5-minute chart. Now we already swept Asia and we already swept London. How can we capitalize off the 10 a.m. candle, right? So the 10 a.m. candle currently looks like this, right? So if we're looking at the hourly perspective, right? So at one point the candle dipped lower right here and it looked like this, right? So there was a wick to the high. There was a wick to the high and the actual body was a full down close candle, right? But when price begins to distribute higher, the wick now presents itself as manipulation, right? This is manipulation. And we can expect, according to the power of three, open, low, high, close, right? So we would expect the rest of the distribution to target a significant liquidity pool, right? How can we capitalize off of this distribution here higher? That's why I like to look to the left. The same exact model we used on the 2-minute to find the down move right here. Remember how we used this BISI to capitalize off the move lower? We use the same exact framework for the move higher. So at 10 a.m., we have this 5-minute candle, 10 a.m. 10:05. What does 10:05 do? If we look to the left, we have the displacement candle here, but we have a 5-minute imbalance, right? Now let me not get too ahead of myself here. Let's focus on the 10:05 candle here. So specifically this candle right here. What did we do to the imbalance? We closed above it, right? Actually, the rectangle is not helping. Let me just do a straight line. So the hourly looks like this as of now. We closed above it, right? Now, if you trade the inverse model solely by itself, this would be your entry. But as we can see here, if your entry is at the close of this candle, you actually experience some drawdown right here, right? When price retraced, this was all drawdown. And it wasn't until price started actually moving up higher past the close of this 5-minute candle, then you were in profit. How can we really refine the range to not experience that much significant drawdown? Now, the inverse fair value gap isn't 100% the best thing to enter off of. Whether it's a retracement back into it, whether it's a close above it, it isn't the best. What I have noticed, in my personal opinions, other people have, different statistics on it, on whether the entry off the close, the entry off the retracement into it is the best. I prefer to I like to see when price closes above it, and then but at the same time, you see how this candle closed here at 10:05. But what did we form at the closure of this 10:05 candle at 10 a.m.? What did we form? That's a little bit more obvious right here, right? We formed a BISI. Now, this BISI alone isn't the best, right? This inverse fair value gap alone isn't the best, right? So if we combine both of them together, we obviously have a BPR now, right? So obviously the gap between both the BISI and the inverse, that gap right there, that is your BPR, your balanced price range. Now this is very high probability right here. Now if I was to trade, if I were to take this trade, I didn't actually take, I just signaled it. I didn't take this trade. But if I was to take this trade at 10 a.m., it would have been, I would have set a limit order right at the beginning of this BISI because that's where the start of the BPR is overlapping with the inverse and the BISI, right? So this would be a high probability setup. The inverse telling you market structure wants to shift, right? So this is not your entry yet, right? The entry is when price seeks fair value because price will eventually consolidate. We have expansion, consolidation, retracement, expansion, or reversal, right? Which is IPDA. So price expands, reverses, consolidates, retraces. So it consolidates, retraces, seeks fair value, expands again, right? And then, so at this point in time, then you have your hourly candle. Assuming this was your manipulation lower, you can actually use the actual wick of the 10 a.m. candle to project. So you see what I did there? I used the wick of the 10 a.m. candle here to project my standard deviations because standard deviations, all it does is project the manipulation, right? And then it projects it. So you use it on the manipulation, sorry, and then it projects your distribution, right? So where would we expect price to go from here on out? Let me put my standard deviations back. We would expect price to go to the 3.5 to the 4, and then that lines up with our 930 high right there. And that's exactly where it reverses for the day. Now, not only does price seek the 3.5 to the 4, right, which is pretty crazy, but this is why I also marked out. Let's go back over here. I marked out London high, high of day, and then low of day, right? So let's just focus on that for now. So we did understand the 5-minute model, right, off of SMT.